Now we have this incredible opportunity to buy this undervalued AI company in the market, Micron Technology. Not only is it trading right there towards its 52-week lows, but we get a strong buy signal from Wall Street, a buy from Seeking Alpha, and another buy from Quant. And on top of that, as we will run through today, never seen before on this channel, an A+ on valuation, A+ on growth, and an A+ on profitability. So we're going to run through this company, AI related, with massive upside, nice margin of safety. But first, we're just going to highlight this company for people that don't know. They effectively manufacture memory and storage products, and these components are incredibly essential for computers, smartphones, servers, automotive systems, powering data storage, as well as high performance computing applications. Now, they did recently release their earnings, and we can in fact see for the more recent quarter, their revenue is up 14% just from Q3. Their revenue is up 93% when you compare it to the same quarter last year. And for the full year of FY 2024, their revenue in comparison to FY 23 is up 62%. And as we will come to show you, there is a lot of growth with this company, not just over the last few years, but also moving forwards. In terms of their revenue, well, when we do split it on a segmental basis, we can see from the same quarter last year, computer and networking up triple digits, mobile up double digits, storage up triple digits, and the embedded systems around 36%, again double digits. When we then draw your attention to the company's capital allocation, which is something we love to do on this channel, definitely check that out for each company you're invested in. They repurchased over the last few years around 4.4 billion in terms of share buybacks. Remember, that is a way a company, on top of paying out a dividend, returns excess cash to investors. They paid around $1.5 billion in total. We'll come shortly to talk about the yield, and we can see this is something they do expect moving forwards. This is what management do prioritize in terms of their capital allocation. In terms of their next quarter, well, they are expecting around 8.7 billion. That is a nice increase from the previous quarter where they did just announce 7.8 billion. And we can see gross margins, something we will come on to, very important, does look very healthy at just under 40%. Now, if we bring your attention back to this company, we already talked about the very strong analyst ratings as well as the growth grades, which are the first on this channel, A+ right across the board. It is trading towards its 52-week lows. We do note they do pay a dividend around 0.45% in conjunction with share buybacks, something we love to see, and something we didn't mention right at the beginning, their forward PE incredibly reasonable at 11.3. That is significantly lower than the sector median. Therefore, they are trading at a pretty heavy discount to the overall industry. Now, over the last 12 months, they are up around 38%. That is very strong. However, over the last 10 years, we have noted pretty much in line with inflation. One thing we do want to draw your attention to is that just over the last few months, this company is down around 22%. A few reasons for this that we do want to highlight today. They did release weaker than expected in terms of the revenue outlook. Remember, analysts do have some very high expectations given the overall expensive nature of the market as a whole. There is a bit of volatility in this area given AI-driven memory demand is strong but also a little bit uncertain. And then you have the main factor here, the geopolitical regulatory challenges. We have trade tensions, particularly relating to China, as well as potential sales restrictions and production costs, which has added a little bit of pressure onto Micron Technology. When we look at the next few quarters from this company, we can see management are anticipating growth, which is a great sign at the triple-digit rate. And when we look back at the last 4 quarters, that is a 100% historical forecasting accuracy. All beats, we love to see that. And on top of that, over the next full accounting year, they're anticipating 1286 for the EPS, which will in turn lower the forward P to 7.87. That is very, very cheap when you do compare it to the overall sector, especially for the metrics this company does have. No surprises why analysts are incredibly bullish. Now, in terms of a few metrics of this company, first one, dividend safety score, borderline safe. We'll touch upon that. We'll run through these two methods as well. But one thing to note, they haven't increased that dividend for a couple of years. In turn, though, what they have done is a lot of share buybacks. In terms of dividend safety, it was just reaffirmed last month. What borderline means, effectively, there is a moderate risk of a dividend cut over a full economic cycle. We could then look at the key metric from the 07-09 Great Recession. No dividend was paid, so no comparative data, and they did have negative 18% sales, which was below the average, the S&P coming in at negative 12. As we said, 0% increase, so we are still waiting for one, hopefully something we do see in 2025. And whilst there are 0 years of consecutive increases, they have been paying a dividend for the last 3 years without a reduction. We then look at the valuation, where we do get an undervaluation signal. Over the last 12 months, what we have noticed, very, very inconsistent. The blue tunnel is effectively the expected fair price, and what we can see over the last few months in particular, this company has been trading below the bottom end. That is an indication of severe undervaluation. However, when we look at dividend yield theory, remember this tells us a company is undervalued when the current yield sits above the 5-year average. We get an overvaluation signal given 0.45 is below the 5-year. Bear in mind that they haven't done any dividend increases as of late, and they're only a new dividend paying company, so maybe one not to place too much reliance on. And then we get to the forward PE, 11.2, that is below the 5-year rolling of 13.1, another undervaluation signal. And as we said, they trade significantly lower than information technology sector as a whole at 28.1, indicating a discount to the market. But as always, bear in mind, we're not concluding on the valuation until we run it through our own valuation model towards the end. As always on the channel, we'll draw your attention to the free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 50% is what we want. Now, we don't get that in 2024, as we will come to show you. This company, the industry it operates in, semiconductors, are very cyclical. What we do notice though, over the next 12 months, it is anticipated to come down to 16%. So hopefully we do get to see a very nice increase in 2025. As we can see, the free cash flow is fairly inconsistent over the longer term. We do notice 11% positive on a trailing 12 month, and a large increase is anticipated over the next 12 months to 285. When we look at sales growth, again, cyclicality shining through the numbers. At a bare minimum, we want to see 3 to 7%, although we do say 3 to 4, that is just to keep up in line with inflation. And when we zoom out, over the last 10 years, we do notice 5 of them have been negative. Nice to see 2024 coming in at 62%. And when we look at it from a numerical perspective, we can see a lot of inconsistency on a year-on-year basis. Now, over the longer term, they have done share buybacks, 1.17 billion to 1.12. Ideally, though, we would like to see them ramp this up at a much quicker rate, given the fact that the dividend increase hasn't come in quite some time. So there are considerations, things that we would like management to improve on, and these we will keep an eye on when they do release their latest earning. ROIC, 10% or more, give us faith management are able to effectively allocate their capital, 12% if we want to be specific to the industry. Again, inconsistency throughout, 2% in 2024. We want to see that minimum 12 for the industry. Not something they have it on a consistent basis, but that is why we always use a margin of safety when we do come to our target price. Operating margin, 2 things we want to see. Firstly, above the 16%, pretty much straddling around that year on year, although some years are not great, in particular 5% in 2024. We also want to see operating efficiency. That is when margins increase over time. Again, not something we see. And then free cash flow margin, pretty much mirroring our thoughts and comments that we just mentioned on the operating side. In terms of the net debt to EBITDA, EBITDA referencing the earnings before interest, tax, depreciation, amortization, below 1.5 for the semiconductor space. And the numbers you see below, number of years it would take the company to pay off all of their debt net of cash on hand. And remember, this correlates to dividend safety, balance sheet strength. 0.65 on a trailing 12 month, anticipated to go even lower over the next 12 months, pretty much telling us the dividend does look to be safe. We did notice the very high free cash flow payout in the more recent year, but it is anticipated to come down significantly. Very low net debt to EBITDA, so no worries, and we will come to show you that when we do analyse the balance sheet of MU. We also want to let you know we have released our latest free weekly article where we run through 2 cheap stocks that have gone under the radar. Now, we deliver one every single Monday morning to your inbox, so a new one will be coming tomorrow where we do highlight severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away. You'll also be able to gain access to 28 undervalued dividend stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next 12 months, and you can grab a recently released copy of 29 undervalued stocks that Wall Street believe have the most upside right now in the S&P 500. Bit of a spoiler alert, Micron Technology is included. Other parts of our analysis include the insider ownership, 0.3%. We see around 80 million worth of sales over the last year, although we can highlight in Q4 there was no movement. You'd have to go to Q3 for around 500,000 worth of sales. And when we do look at it for full transparency, you can see the most recent sale was on the 26th of September, a little bit outdated. On top of that, not one that we do use as a bearish signal, as we do continually say management insiders sell for many reasons, personal and financial. In terms of institutional ownership, 81%, around 8.35 billion worth of sales over the last year. A little bit more buying during the same time frame at 9.55 billion. However, we do have to highlight that institutions have sold more in the more recent quarter versus buys, and that is something that we have seen for the first time since Q2 in 2023. Now, do remember you should always do your own due diligence, never copy what insiders or what the institutions do. Now we're going to look at the income statement. We've already talked about their revenue. Over the longer term, it has been very, very inconsistent. And what we really want to draw to your attention is the bottom line net income, not something we have covered as of yet. What is the story to tell us here? And pretty much mirroring their top line, inconsistent and following the top line. So these are things that you do need to consider when thinking about buying companies, not just Micron Technology, but also those that do sit in a very heavily cyclical industry. Then we move on to the balance sheet, total cash versus total debt. For a quick health check, cash over the longer term has been increasing, going from around 3.5 billion in 2015 to 8.1 in the latest quarter. And then we compare this, because that number in isolation won't tell us anything, to their total debt numerically and directionally. And what we can in fact see here is that it has increased, pretty much doubled from 2015 to 2024, 7.4 billion to 14.1. Now we did have a quick look at the net debt to EBITDA, pretty much telling us the balance sheet as a whole does look to be secure for the time being, but again, things that we do consider on a quarter by quarter, year on year basis. Now at the beginning of the episode, we did say never seen before on this channel, AAA+. So let's get to it. In terms of valuation, A+, that is because the P on a non-GAAP basis sits at 11.3, which when we compare it to the sector median of 26.5, means that if you're buying Micron Technology right now, you are getting a massive 57% discount to the overall sector, and something that is mirrored for the large part against whichever valuation metric you use. Now, has the market overreacted, or is Micron Technology deserving of this massive discount? Something there to consider. Then we look at the growth grade, which tells us, you know what, it doesn't deserve to trade at a discount, given the fact revenue year on year, 62%, better than the sector median at 4.4, revenue forward looking, 44%, better than the sector median at 6%, EBITDA growth, triple digits, 2% for the sector, EBITDA growth forward looking, again, triple digits, and on top of that, just look at this, EPS growth over the next 3 to 5 years, 51% on a compounded annual growth rate, the sector median 15.44. Then we get to profitability, where they get another A+. Gross margin, not great at all. In reality, 22 is a lot lower than 51 of the sector. Bottom line though, not far off, 3.1 versus 3.71. But one thing that we do like a lot, their cash from operations, 8.51 billion. The sector as a whole, 98 million. Now, as a quick recap for this part of the analysis, a double buy rating from Seeking Alpha and Quant, a strong buy from Wall Street, A+ valuation, A+ growth, A+ profitability. Now, two more things before we jump into our own evaluation, comparing their performance against others in the semi space, those of a relatively similar market cap. And then we get here, over the last year, including dividends reinvested, Micron Technology up 39%. Not the best performing, not the worst performing, but a very respectable performance. Over the last 5 years, again, very respectable, not the best, not the worst, 115. Over the last 10 years, around 200%. Again, the same does apply there. But remember, whether or not you do like that rate of return, that past performance is not an indicator of the future. They could perform a lot better, they could perform a lot worse. We also like to do the same thing for the S&P. Well, not too far off, a marginal beat over the last year. Over the last 5 years, again, marginally higher. And when we look over the last 10 years, pretty much in line. So it hasn't had a massive difference to the S&P, but as always, do consider if you are buying individual companies that you look at those that you have faith over the long term that they will outperform the S&P 500. Now let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. $138, that is our intrinsic value derived from the DCF model. And when we get to the discounted cash flow model, we can see the average growth rate over the longer term at 226%. Although bear in mind it has gone from negative to positive a few times, which does skew the data. We've gone for 15% moving forwards. With the discount rate at 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, 138 indicating 36% upside. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for MU or any others. Full transparency though, at the 10% rate, intrinsic value $100, pretty much meaning if you do believe they will grow around that level, right now it's trading around its fair price. And for those who are a lot more optimistic, at 20%, $188, indicating 86% upside. Now we will use the 15% medium rate where we will apply a margin of safety like we always do on this channel. We'll start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy up to $124, then we keep going till it's near the current trading price. And what we can see in today's episode, up to $103, you are getting a 25% MOS. At 30%, you would have to wait for $96 to $97. And Wall Street, incredibly bullish. They see around 50% upside just over the next 12 months. Their price target is $150, meaning it is one they believe you should severely consider in your overall portfolio, especially if you don't have exposure to this industry. But as always, you can consider semiconductor ETFs if you want to have a bit more security. As always, give us your thoughts in the comments below. Is this one you're buying? Maybe one you're looking to buy, or for whatever reason, not one you're looking to consider. Don't forget, if you enjoyed today's episode, smash that like button, hit the subscribe and bell button. Don't forget to sign up to the free weekly newsletter below. Grab those spreadsheets and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.